Hey guys, so a lot of interesting things happened this week in the market. So I figure I will give you an update and also talk about a couple other things that recent developments that I also find interesting. Okay, so it's been a quite an exciting week, as you know. We had this banking crisis in the Silicon Valley, right? With the Silicon Valley Bank, and earlier than that, there's also the crypto bank, which is the Silvergate, and now there's another one which is a signature, but it's a like a relatively smaller one, right? So they all failed basically, and Thursday, Friday, there was quite some panic in the stock market. All the financial stocks went down, right? So want to give you some thoughts on this, but let's start from the beginning, okay? So back in January. So basically, if we look back, the development in the crypto market the past 2 3 months. So we started a bull run. Basically, the counter trend rally started in early January, and as I mentioned, we discussed in the previous episode of this, these counter trend rallies in the bear market, they're like short and sweet, right? Or short and violent, depending on your perspective. But basically, it's like it started early January and basically it ran about 2.5 weeks, and that's about it, right? So after like late January, it's basically been just in distribution mode, right? So whoever's made money from that bull run in early January started to sell, right? On the other hand, there was not so much of a consistent, well, there are some, but there are not like so consistent buying power, so to speak, to follow up on that trend, right? That's why we are in a bear market, right? That's the definition of bear market is the seller's force is generally greater than the buyer's force, except in these short episodes of counter trends, right? So in February, basically the entire market is in sort of a distribution mode. And I would say, if you look at the US stocks, it did like a similar thing, right? So we had a strong rally in starting January. And then, remember if you listen to the last episode that we did, also the market update episode. At the time, I was thinking the inflation, because the January rally was largely based on this assumption that we're going to see some sort of monetary regime shift soon because inflation is coming down. So, but at that time, I thought yes, inflation is coming down, but it's not really that fast. Okay. And that's for a lot of reasons. One reason is China, and also there are other reasons, such as basically the bottom line is the economy in the US is very strong still, right? If you look at the employment report and so on. So people are still, willing to, the demand is still strong. It's coming down, but it's not like in a recessionary territory. So the entire setup is just like, the timing is just not, it's premature to say, oh, this is the time where Federal Reserve is going to switch direction. Because it's like inflation is still far away from their target. And if you look at the central bank's balance sheet, it's like way above the level before the COVID, right? Because they just overdid the quantitative easing during the COVID episode. But at the time, you can also say it's all like in hindsight. You can tell, okay, we overdid it in terms of monetary loosening. But at the time, before the event, when the COVID crisis was happening, nobody had a clue how bad things would have gone, right? So these things, hindsight 2020, but in any case, central bank balance sheet is so much bigger than 3 years ago. So now they have to, like, it takes a while for that part to wind down, right? So, which is also the reason, why I think since the second half of last year, you basically have not seen that much of a precipitous decline in the market. It's really been like very mild, right? So, and then you see like the January bull run was like, once it started, it got a lot of retail participation again. So the sentiment was like suddenly, it very quickly just turned, bubbly again, so to speak. So I think the reason is, for the large part, is there's still so much liquidity out there because of that large burst of quantitative easing that went out the door during the COVID, right? So liquidity is not in shortage out there despite the rate tightening, right? So you can see like the market was going down because overall environment was hostile, macro environment was hostile, but it's not. It was definitely taking its time, right? It's not like in the crisis selling off mode. And there is still, at every juncture, there is some buying out there, because we are still overall in a very loose liquidity environment. So the monetary condition is de facto really still not that tight. You can see that in the market behavior. You can also look at the financial, conditions index, that's officially calculated by Chicago Fed and by other sources. So it's really like de facto, there's not nearly as much tightening as the rate hike path would have signaled, right? So that's why I think, we are in this environment. We would have some like these counter trend rallies, but overall, it's still going to be the tightening environment is not going to change in the short term. Okay, so that's my basic assumption, is that we are going to see some of these pretty swift and pretty strong, powerful, like counter trend rallies, because there's so much liquidity out there like waiting to be deployed, and the animal spirit of like speculation is alive and well out there, right? But seriously, it's like I don't see any sign of the macro environment seriously changing still at this point. So which brings us to what happened this past week with the Silvergate Bank and then the Silicon Valley Bank, right? So people are making a big deal out of these things on Twitter. Obviously, my Twitter feed is all the crypto and startup people. So this is a very skewed sample set, right? So, but if you are listening to this, that's probably your sample set as well, I would assume. So it made it sound like it's such a big deal, because it is to the venture world, right? Because a lot of startups park their money with Silicon Valley Bank, and Silvergate is obviously one of the largest vehicles of fiat on-ramp and off-ramp, and the banking partner of a lot of crypto companies in the US. So that's like a significant to these sectors per se. But in the grand scheme of things, Silicon Valley Bank is just like a mid-sized bank, right? It's like $200 billion is the size of their balance sheet. And Silvergate is like a 1/10 small. No, it's actually, I think, what's the size of Silvergate balance sheet? It's about 10 billion, right? A little bit more than 10 billion. So it's like a Signature Bank. It's even smaller. I think Signature Bank It's like 1/10 the size of Silvergate. Yeah. So in the grand scheme of things, these add together, it's like less than 1% of the U.S. banking sector. So you see, but in any case, this kind of thing happened, and FDIC and the Fed responded pretty quickly, right? So they are selling it. They're gonna, sell the bank either like piecemeal or as a whole. I don't think it's gonna be that difficult to find a buyer because the clientele is a pretty attractive clientele, right? Like high growth startups, that kind of thing, and high net worth, like venture funds or like startup founders, that type of clients. So, and they were before this episode of like a rate hike, they were pretty profitable, right? They were profitable year in and year out. So this is not one of those like a toxic asset kind of scenario, like you will have like trouble really selling this basically the ownership rights of the bank. So I don't think that it in itself is that big of a deal in a macro sense, in a systemic sense, right? But really, it's like in the smaller circle of crypto and the startup world, obviously it's much bigger. But that's exactly the problem of these banks, right? Because all these three banks, the Silicon Valley Bank, Signature, and Silvergate, their depositor base, they're not normal banks, right? They are like industrial banks, basically. Their client base is very concentrated just in one sector, which is crypto and then, venture-backed startups, basically. So that is like this kind of clientele is very, very pro-cyclical, right? So they grew so much over the COVID period because the loosening of monetary policy really, the sudden burst of liquidity really benefit the startup world, right? So startups and venture funds were awash with liquidity, and they parked those liquidity with these banks, obviously. So their business model is like very pro-cyclical, and so obviously the direction the wind changed, it was the monetary policy, and they were also the ones that suffer the most. But these are not really like a general phenomenon in the banking sector. These are just like very isolated cases just because of specific circumstances of these banks, right? So in general, the news just came out that the depositors will be made whole essentially by the U.S. government, and the government will be backstopping all the deposit withdrawals. Okay, so that's all fine, but it's like but people seems to be taking it as meaning, some people, okay, as meaning there will be a shift in the direction of monetary policy because somehow things are starting to break, right? So my thought on this would be not at all. Because if you look at if you weigh the importance, the different relevance and relative importance of different factors in deciding the monetary policy directions, inflation is it's a much bigger elephant in the room, okay, compared to these isolated scenarios. So, when you have these abrupt shifts in the monetary policy environment, well, definitely something's going to shift, right? So you have like such a fast regime change in macro environment that is going to cause some segments of the economy to the risk in some segments of the economy to start to emerge, right? But that does not mean there is some kind of overarching sweeping increase of risk level, right? So so basically, when you have these segments of risks and segments of things breaking down here and there, right? The government will obviously you need to deal with these things, but does that mean that you are going to change your overall direction of monetary policy? No, I don't think so. You know, it's like so you see like after this news came out, like um, that the Federal Reserve, is going to backstopping deposits from these banks. Crypto markets started going up, right? So that I mean, if you're a short-term trader, so I'm recording this on Saturday evening, right? It's March 12th, Sunday evening. So obviously this is like positive news to like financial stocks and stuff. So I would not be surprised if Monday morning comes around and we see a swift recovery of these like financial stocks and so on that was being sold off over the last week. And but if you're a short-term trader, obviously these are opportunities you take advantage of. But in terms of like a long-term change in the macro environment, I don't see it. Okay. But on the other hand, if we look at like where we are in terms of the crypto market, so I posted something on Twitter yesterday because I was looking at something that I follow quite often is the market breadth, as you know. So if you look at the percentage of active crypto tokens, like among the top 1,000 tokens with the largest market cap that are trading above the 40-day moving average. Well, you can use any, 40-day, 50-day, 30, 100-day, whatever. But as long as it shows you some movement, right? So this is like a very much in tune. The movement of this market breadth metric, it's very much in tune with just like the positioning of crypto market, like the crypto cycles, right? So you see this metric went up from like about 20 at the end of December. It went up so fast, very quickly reached like over 90%. So basically by third week of January, it's like 90% of actively traded tokens were above the 40-day moving average, right? So that tells you like how fast that mini bull run actually ran up, right? So this was the other thing that I talked about in an article that I put out a couple weeks ago, right? So if you compare this January, like a mini bull run, with like kind of a similar run in early 2019, basically a cycle before, right? You notice that the market breadth like increased so much faster this year compared to the previous cycle. So I thought that was like very interesting because like everything is moving together instead of previously the narrative in the crypto market is like there is a market rotation, right? The large caps like Bitcoin, Ethereum will go up first and then they will spill over into the smaller caps through these portfolio rotations, so to speak. But is that still happening if you look at the recent data, right? Starting the January bull run, not really that much anymore. So once that market cycle, that mini cycle started, basically everything went up all at once. So there was hardly any rotation going on, right? So, but I think it just tells you, I think there are several factors, right? There obviously access to different tokens through like exchanges are much easier compared to before because you have like a lot more listings of different tokens on like major centralized exchanges like Binance and Coinbase. They have a lot more tokens compared to one cycle before, right? So, and also the awareness, like the penetration of crypto is like a much more mainstream, right? So a lot more people, it used to be like people only knew about like Bitcoin or at most Ethereum, right? A few years ago. But now it's like a lot more people is like experts on all sorts of all sorts of stuff going on in the crypto world, right? So as a result, I think you see these like if there's any rotation at all, it happened like really, really fast. Okay. But then, you know, like I said, after January, it's basically in distribution mode, right? We were like um, basically, if you bought like after January, you were being the exit liquidity essentially, right? So but you see like that market breadth like dropped really fast, like since February. So um yesterday when I ran this, yesterday it dropped like below 10. Okay. Yesterday it was like 8%. Basically 8% of active tokens above the 40-day moving average. So what it tells you, so usually is, again, this tells you where we are in terms of like the mean reversion type of market cycles. Okay. Not like the bigger market cycle, but like just like a smaller, like shorter term market cycles. So usually this like metric per se, it oscillates between like 10 and like 85, right? It rarely goes above 85 to 90, 95. That was like really, really high. When it goes above 90, it usually means like market will start to turn, right? Because that means usually you think about it, 95% of the tokens already above 40-day moving average, like usually that means the market needs to take a breath, right? At least some consolidation, if not going straight the other direction, right? On the other hand, it also, not very often it goes below 10, right? So when it goes below 5, it's usually, some kind of market turn is in sight, right? So right now it's like yesterday when I checked. Now today the market kind of like suddenly rebounded like 5% or more. But yesterday when I checked, it was like 8%. Okay, so we are like much closer to the lower bound compared to the than the upper bound, right? So what this tells me is, basically, the market started dropping since the end of since the third week of February, right? So if you take out these, today after the news came out that the Fed's gonna backstopping the deposits and so on, you see like there has been a market downtrend, right? So, but the market breadth indicator essentially tells you, we are, getting there. Basically, aside from these, single events like a, bank crisis or, federal actions in terms of, what they're going to do with these banks. To me, these are all like, to be honest, short-term noises, okay? If you look at the long-term trend, what is really governing the long-term trend is really the general macro environment, right? And the sentiment, the market assessment with respect to where that macro environment is. So in that sense, I would expect some more consolidation from here. Ideally, I would want like a month or so of consolidation here. And then, I would expect to see another kind of short-term counter-trend move. Okay. So that would be my baseline. So basically this right now today, this like right now as I'm looking at this, like total market cap of crypto market is going up like 6% today. Okay. Which is a lot. But this is because of this news coming out that the Fed's backstopping the deposits from these like troubled banks, right? But again, so basically the market is taking this as a sign that there will be some shift in monetary policy is starting, which as we talked about, I don't think is true. Okay, so I would just fade this move, which is the bottom line. But if you're a short-term trader, that's a totally different question, right? Um, but let's see. What else? So the other thing I want to talk about is, okay. So the Silvergate Bank and the Signature Bank. So basically, these are the primary banking partners of crypto companies, at least in the U.S. They have other countries exposure as well, right? So obviously then if these banks went away, there's the question of where is that on-ramp and off-ramp from crypto to fiat world? Is that going to be disrupted? I think there will be some level of disruption, right? So at least in the short term. But is that going to be eventually an issue? I don't think so. Because any type of business as in any type of business, if there is an opportunity to make money, if the older players go away, new players will step in. People will find solutions to these things. So over the long term, I don't think this kind of like banking partner issue is specifically a big deal. However, what I think would be really a bigger deal, to the, I would even call it at a existential level for the blockchain economy. Okay, it's something else, which I think it's not as many people are talking about because it's so new, and also the crypto and Web3 world is like in its own bubble, right? So if you look at the news, like last week, Brazil central bank started this pilot of basically their own network of tokenized assets, right? So that's the direction they want to go, is to tokenize TradFi assets through their CBDC network. So this is something, and also obviously, there are like more and more countries exploring CBDCs and so on. Now, this is something, to me, is going to be a longer term, more of an existential threat to the blockchain economy. Why? Because these networks are essentially, I think what they're going to do is they're going to essentially copy a lot of features that are originally innovated by blockchains. Basically, smart contracts, programmability, and allow these instead of like siloed applications like in Web2, you have interoperability and composability across different applications and protocols, that kind of thing, right? So essentially, interoperability, programmability, composability. These used to be the building blocks of the Web3 economy, right? So these are like productivity enhancing features of Web3 that allows you to innovate faster, allow you build on top of like each other, and basically allow users to take their assets, take their identities anywhere they go in the blockchain economy, and improve the efficiency and so on and so forth. So, but all these innovations, so to speak, do not have to be limited to blockchain, right? I hope you do realize that, right? So it was made available, it was created, innovated on the blockchain, with like Ethereum being the first one, right? But you do not really have to use blockchain to implement these concepts and these features, right? You can totally use centralized technology, centralized databases, or other types of ledgers or distributed ledgers, but you can make it how little of, you can control that how distributed you want the network to be, right? So essentially, these will be the approach. This will be the approach of these. I think the CBDC networks. They're going to copy the features that are basically obviously is creating some kind of network effect and creating the productivity improvement from blockchains, and they're going to create their own thing, right? So basically, all the features of blockchains, since the decentralization, since the non-KYC part, because these networks will be KYC, right? So you like people accounts on these networks will be identified, and also you would not have it will be like border controlled, right? So it will be most likely confined within a national economy, a geographically defined region that is called a country. So, or a group of countries like the European Union, that type of arrangement, right? So the features these types of networks would not have is globalized liquidity and borderless access, right? And also, decentralization is not really a productivity enhancing feature, so to speak. It's more like, with the public blockchain, they have to have decentralization for security reasons. But anyway, my point is, these will be essentially, and I think in a few years, will be the competitors essentially to the general purpose type of public blockchains. And they will be going after the same type of applications and the use cases and the customers, essentially, right? So if you're an application, if you're a protocol, you can build a financial app, or you can build some kind of utility tokens for your applications. You in some kind of digital transaction network, right? You can now when we talk about Web3, it's like equivalent to blockchain, but in the future it does not have to be, right? And I don't think it will. So because like the concept of tokenization of assets and tokenization of values and interoperability and smart contract, all these things, they really are independent of the technology that we call blockchain today. So essentially, I think these will be more of an existential threat to the blockchain economy that we know today. Okay. So because these networks, their disadvantage is that they don't really have the kind of fast to market kind of innovative capability that comes with this decentralization, right? Comes with a distributed network. So their implementation will be slow, or their innovation capability will be slower, but their advantage is like it's already plugged into the distribution of the monetary system, right? And you have already, there will be no friction in terms of fiat onboarding or off-ramping, or with the connection and integration with the existing financial system, and there will be no problem there, right? That is the weakness of the decentralized blockchain economy, right? Now, on the other hand, there are advantages of the public blockchains, which, as I talked about, decentralization gives you the ability, in some cases, to you will see like pockets of innovation happening around the world on the same platform, right? So you will have like faster innovations, you have more innovations, and also there is this priceless thing, which is the global liquidity network, which is borderless, right? So those are the advantages and disadvantages, really, of blockchain vis-a-vis these centralized types of networks, which will be showing up, which will be popping up in coming years. Okay, so I think it'll be really interesting to see who gets a bigger market share in the future, because those will be competing with each other. And to me, this it's all good news for the Web3 economy, right? Because the Web3, again, it's a modality of it's a concept of how you run the economy. It's a business model. It does not have to necessarily rely on a certain type of technology, right? So that in itself, it can run on the CBDC network, it can run on the blockchain, it can run on the centralized database, no problem. But each of these infrastructures have their pros and cons and have their competitive advantages, and they are going to just compete it out in the marketplace essentially in coming years. But that that I think is actually the biggest competitive threat to most of the general purpose blockchains that we know today. I think it would be more it will be there will be, for those blockchains that have a very specific purpose, which is meaning they are very specific in terms of their use case. Either that's it's a network that serves a one or two application, which people call it app chains, that kind of thing, or just serve one or two specific sectors and kind of really optimize for that specific clientele that they serve, basically specialized blockchain networks. I think those will have a bigger chance of success compared to these general purpose networks that are essentially, trying to be Ethereum, but faster and cheaper, right? So I think those will have more and more of a tougher time to attract liquidity once these essentially a nation state sponsored digital transaction network start to jumping into the fray of competition, right? So so that's basically what I want to talk about today. So again, this to me, what people talk about on Twitter, the impact of Silvergate or SVB, impact on crypto and impact on the startup world. There's some people, even you see some venture capitalists making some extraordinary claims, saying Silicon Valley Bank, if it's not saved, it's gonna set the U.S. technology sector back 10 years or something, or it's going to destroy the innovation economy or something. I was like, seriously? What kind of what kind of stuff these people are smoking? No, but it's it's totally understandable that they will say that, because they have a stake at this, right? They probably have money stuck in the SVB, or they have their portfolio companies having a hard time, which is understandable. But really, the reality is it's just a $200 billion asset company, bank, right? It's in the grand scheme of things, very small. And the U.S. innovation economy, give me a break. It's really not. It's not really not that fragile. Okay, right? If you're, especially in the startup world, if you're an entrepreneur, for those of you who are entrepreneurs, cash flow problems, this and that kind of calamities. It's it's just another day in business, right? It's innovation economy is so strong in the U.S. It's exactly because there's so many people, so many entrepreneurs, and the resilience behind it that's making it so strong over the years, right? So just one bank closing doors is not going to destroy anything, basically. That's the bottom line. But people say whatever they say in the media to serve a specific purpose, right? So, okay, so that's all for today. I'll talk to you next time.